Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 21st of February, and oil markets are trading somewhat flat continuously, would appear this week and since really a number of days now. But, holding, I think, is probably the noteworthy point that oil markets are holding at these levels after since the beginning of the year. Most of January and early February, we saw a lot of up and down between the sort of 76 and low 80s. And now we're seeing Brent crude trading around 82.50 and more or less holding at these levels. And the question is, where do we move from here? Victor Yang, senior analyst at JLC Network Technology in China. Victor, coming out of the Chinese New Year, new records in terms of travel across the holidays in China, and will that be the catalyst for this, eventual recovery of the Chinese economy coming out of COVID? That this new signal, because the consumer signal, right? Everybody's willing to spend money on airplanes to go home to see their families. Will that trigger a new wave of growth in China?
Good morning, everyone.
Good
Yes,
morning.
well, we saw record travel during the Spring Festival, and it's still continuing because we had a 40-day Spring Festival travel rush, which will end later this month. And as for spending the consumption around the travel, well, also drawn. And this is a good signal for the country's confidence. But this is mostly related to tourism and travel. And for the other sectors, well, it's still recovering slowly. But spending, after the holiday, will retreat to some degree because of much less travel. So the country is now working hard to stimulate people's confidence, including the rate cut and some other measures too. But on the whole, it's kind of improving. So on the whole, the confidence is improving gradually. Yes, this is a good sign for the country's economy.
Dr. Aman Nasri, Managing Director, Middle East at FGE Dubai. Dr. Nasri, what's your read on that? China's recovering, OPEC plus supply continues to be quite constrained in terms of over 6 million barrels of agreed cuts currently under implementation. Where do you think those two things go as OPEC plans its post-Q1 supply decision, looking at China coming out of the new year, significant cuts still at OPEC plus? Where do those two things come together for the next OPEC decision?
Yes, definitely the sign of recovery for the market, the demand is there. We have call on OPEC plus, which is the residual of demand growth after growth in non-OPEC plus supply, which is also not insignificant this year, is still on the upward trend from first quarter 2024 all the way to 4Q 2024, and that indicates that if the OPEC plus were to keep the market balanced, they would have a trajectory ahead of them to stick to that call on OPEC plus and gradually increase their production or phase out cuts as we move into second quarter, third quarter, and towards the end of the year. So that would basically keep the market balanced and prices at around $80 to $85 in a kind of flat market. That incorporates what Victor mentioned and you alluded to, which is the expected continued growth in China. And and the last leg of COVID recovery that we expect to happen this year, with about 400 KBD of that COVID impact yet to be recovered this year. That included into the plan. So again, depending on their actions going forward upon the expiry of the 1Q cuts into the second quarter, they could basically leave the market with some build and draw, which is okay to have that because there is a seasonality in inventory trends historically. So it doesn't have to follow exactly the call on OPEC Plus, but overall, the trend suggests that there is now basically an opportunity for OPEC to start to phase out the cuts. How much?
Okay.
Yes, how much is depends on everyone's view on that. We find it about half of the latest, the most recent 2 plus million barrels per day cuts can be unwound this year.
This year. Andre Bellier, PhD, professor, founder and CEO of Balsen. Welcome back, Dr. Andre. Lovely to have you. Europe is enjoying, I mean, enjoying is a big word, but nonetheless, after the incredible stress of last winter, with the sky-high gas prices, natural gas prices, this year all looks calm. Is that an accurate reading of the energy crisis that we called it last year now in Europe this year?
Yeah, basically the peak of the energy crisis is over. So European Union was successful in diversifying its energy supplies, and in addition to that, overall, let's say the market trend turned into positive direction for the European Union. What is very important to know is that carbon price and the gas price have been quite correlated in the European Union. When gas prices spiked, ETS price, emission trading scheme, or carbon price followed. And they basically pushed each other at some point, because when the gas price is expensive, you need to use coal, hence carbon price increases. And the other way around too. When you have carbon price going up, then of course you have the gas price, which is also stimulated. By contrast, once natural gas prices relaxed, the ETS price or the carbon price went down as well. And what we are observing now is a decline of the natural gas price and the decline of the ETS price, which means that the energy crisis or the peak of the energy crisis is behind us.
Victor, we still see this week China coming out of the New Year holiday. One of the first actions of the Chinese government was to announce its biggest ever reduction in the benchmark mortgage rate, which was yesterday, the 25 basis point cut to the 5-year loan prime rate, the LPR as it's called in China. Is that a significant move? Is that a stimulating move? How should that be read? And where do you think the idea of stimulus in China to help the Chinese economy, but starting with this announcement yesterday of the rate cut?
Yes, well, it was quite a significant move. It's a very large cut, and compared with the past few years, that's quite large, and well, above expectation, I would say. And it's mostly aimed to help stabilize the real estate market, because for the 5 years over mortgage is basically about house purchase, and it can help to reduce people's kind of pressure on mortgaging. But this will not stimulate demand for houses much, because people still expect the house prices to drop further. It's not bottom up yet. And there is still some room to improve the confidence. So they're not so confident in the real estate market yet. And as you know, we talk a lot about the debt in the real estate market last year, and this continues this year. So people are still waiting to find out how this will evolve. And so this can just help to not very much to stimulate demand yet. They still need some other measures. And because in China, the real estate industry, also the market is not a free one, and people cannot just cut their prices to stimulate sales as in the other markets. Say, if the house prices are too high, and developers cannot choose to cut their price to get their fund back because of government policies. And if the price go up too much, the government will also regulate it. So this is not a very free market yet.
Right. Dr. Nasseri, I wanted to get your thoughts on just picking up on some of the conversation with Dr. Andre, the idea that natural gas prices have collapsed in the US. They're near 30-year lows. There's a fairly warm winter, full storage in Europe. Where does that leave the outlook for gas, and particularly LNG, which seem to have obviously got a lot of momentum from energy security being the top priority coming out of the Russian invasion of Ukraine? Does gas drop away now? Do countries back off from building that expensive infrastructure? What's your thoughts on the outlook for natural gas, LNG, given what we're seeing, particularly in America with the Henry Hub price near a 30-year low?
Yes, the current situation is a very short-term phenomenon, and basically always winter prices and the sentiment in the gas market is very much weather related during the winter. So it's certainly the warmer than normal winter is playing a big role in what we're seeing now. Whether that defines a medium to long term or that impacts medium to long term trajectory on demand or even investments and supply, which is in nature a long term phenomenon, that I doubt it. I have to say that the market we expected, and everyone following the gas and especially LNG market, which is relevant for trade and for Europe imports in the aftermath of losing Russian gas, that everyone expected a rather tight 2024 and 2025 because of lack of basically capacity additions before the new wave starts to come to the market from 2026 onward. Now, 2024, I think, is two phenomena is happening at the same time. One is that we're having a warmer winter, and demand is basically suppressed and depressed, but people anticipated that basically pressure on LNG prices because of continued demand growth and lack of supply, and prepared for this. So I think quite a lot of portfolio players basically well prepared and had portfolios and spot cargoes available. So the market prepared itself for a tough year, yet that tough year didn't happen. So the combination ended up into this kind of low prices because we expected this is here, and now we're basically in an oversupplied market or over prepared.
And that was
that's what's happening.
And that was always, I think, given even the long-term forecast from 2018, 17, it sort of saw the mid-20s as a surplus window, given particularly the amount of new supply coming from Qatar LNG. Dr. Belya, I wanted to get your thoughts. I mean, just putting together some of those sort of outlooks for gas, LNG, but in the context of energy security in Europe? We saw obviously all of this, as we talked earlier, become a major crisis as it was described last year, ultimately because of the energy security situation with Russia. The war in Ukraine had compelled the European countries to turn away from Russia, their natural gas supplier, and look for other suppliers, and particularly have found refuge with the US LNG as the replacement. I wanted to get your thoughts on the outlook for that. Where is Europe now as it looks forward with its energy security, the return of Trump potentially, and the European dependency on the US LNG now? Where's the thinking in Europe going vis-a-vis the outlook for energy security with potential Trump back in the White House, Putin obviously, and the war in Ukraine still ongoing? What does that look like? Is there enough thought going into that? What's your vision for that?
Well, obviously, reliance on LNG markets implies several risks, several market risks. Now, of course, the expectations of the crisis were higher than what is actually ongoing now in Europe. However, we may expect high prices to come back. Moreover, for Europe, it's not only potential Trump administration, which brings kind of like thought of the political instability that is problematic, but is also Biden's administration, which decided to complicate future and new LNG exports, and that's definitely created a certain debate in Europe whether it is necessary to further cut natural gas demand. Yet, here it's a very important point to mention that the problem is not only the energy security. Europe seems to be able to pay high price for its own energy security and to get out without a major crisis. However, the industrial potential in Europe has weakened, and that basically implies that part of the natural gas demand decline is due to the declining industrial potential. And that in turn creates several political tensions, political debates about whether the Green Deal and the transition at this speed is accurate or not. And we will have European elections in May, and I'm sure that this part of the debate about the industrialization and about the energy security will be on the table, because we have to understand that natural gas is competing with green energy on one hand and with brown energy such as coal on the other hand. And the growing ETS price, which is partly triggered by the European climate ambitions, is definitely creates an additional barrier to a competitive economy. And this basically contradicts to the current European.
Do you see any noise or any consideration yet in these reevaluation of US as a secure supplier after the announcement by Biden that there could be a turn back to Russia if indeed there is a deal done on Ukraine, that Europe could turn back to the very attractive, cheap pipeline gas from Russia?
That is very unlikely, because it's not only Europe who doesn't want to buy Russian gas. We have to remember that Russian gas started to decline into the European direction from summer 2021. So we have to be realistic, even if somebody from Paris or Berlin or Brussels will start calling Kremlin asking additional volumes, we have to understand that the other side have been reducing gas supplies. And even if they agree to increase the gas supplies, that will have political implications that many in Europe will not like. And therefore, this scenario remains very unlikely.
Okay, let's get the survey question, which is looking more macro regarding the relevance of interest rates at this point in time for the oil markets. Oil markets have priced in rates to stay higher for longer. Agree or disagree? Brent crude oil in the low 80s, where it seems somewhat stuck at the moment, has priced in that rates were going to stay higher for longer. Victor, I wanted to get this perspective from China because it's regarding the geopolitical events in the Middle East. They're quite significant, of course. They're on our doorstep, so we feel the immediate drama and trauma of what is happening. But from a Chinese perspective, China is the current president of the Security Council. The U.S. vetoed the ceasefire resolution yesterday. From a China point of view, is the crisis in the Middle East, in Gaza, is it a big story? Is it a concern? Where does it rank in general thought? I mean, obviously, China is the biggest. I mean, in terms of major economies, depends heavily on energy from the Middle East. So I'm curious as to where this very big story plays in China, which we don't hear much about regarding the crisis in Palestine.
Well, yes, it's a big concern for China because it concerns the country's energy security and trade too, some other issues too. And we depend a lot on energy from the Middle East too, and this can dampen the country's energy security. And of course, the whole environment for global trade is unstable, which is also threatening the country's export. So the country is now is hoping for a ceasefire, that's for sure. And in 2024, we are seeing more uncertainties, and this is a great challenge to the country's economy. So it's a great disadvantage, a great concern to the country.
And in that concern, it is the energy supply or the trading routes, i.e. the Suez Canal or the Red Sea. Are there any indications yet that this is actually costing the Chinese economy in any tangible way? Is there any data point that could, we saw during COVID, of course, supply chains and shipping hugely disrupted, back up at ports and so forth. Is there any tangible evidence so far that you can see from a China logistics supply or energy supply that the crisis is impacting?
Well, for energy supply, there's not very significant impact yet, but the prices have been different. So the tension can push up prices and push up Chinese refiners' cost. And this will dampen its demand on the whole, so including crude demand and fuel demand. So in China, when fuel prices are too high, some people might not use their car often. And this is dampening domestic gasoline demand too. And for the country, for refiners, if the crude price is too high, and they would reduce purchase. Yes, this.
That was useful. Thank you. Dr. Aman, when you look at this crisis, obviously we just had the survey question about rate cuts have bedded in the oil markets, the oil prices bedded in, priced in the current outlook for rate hikes or rate cuts for that matter, i.e. the rates will stay higher for longer. Has this oil market already also bedded in the risk to supply disruption from the Red Sea, from the Middle East, between the different crises in the region, that the oil markets have more or less priced that in to the market? Your thoughts on that, and is that an accurate assessment of the situation?
Yeah, I was talking to one of my clients, a trader, yesterday, and I was saying that the market is getting more and more confused how to price in all these, because there are now multiple geopolitical risk factors that have been happening, expected to be short-lived in such basically relative terms. The market reacted. The market was wondering whether they should basically move away and basically phase out that, and it has accumulated. They have stayed. I mean, you remember a year ago or so, everyone was talking about Iran volumes coming back. So there's the sanctions and the deal that kind of stayed. Now they're out. Whether there will be an enforcement, the barrels came back in, and whether there is an enforcement to move. Then we had Venezuela. Now the barrels are out. The market has basically built some uncertainty around how long those barrels will stay in the market. Then we had the, in between, we had the Russia situation, which people expected a short-lived. Now it is here. Then we had Gaza, and now the bubble mandate, the Suez Canal. So my answer to your question is that yes, this one, perhaps, if you want to look at it short term, what we look at the fundamentals of the market is not as tight as the prices suggest, but maybe it's an overcooked situation of the rerouting or the impact of the reshuffle, the trade reroutes on the supply. But at the end of the day, the impact, the size of the risk that they're building has shrunk. So all of these individually could have had $5 to $10 impact in the old days. Now there's so much uncertainty that the market is perhaps total altogether. All these factors that I told you, maybe we could identify $5 at most as a risk premium to the market.
Dr. Belli, just last word with you. You mentioned in your earlier comments that there are a number of elections coming. Obviously, globally, we're having a lot of elections. Pakistan, Indonesia has already happened. India in the east, but in the west, we have other elections coming. But notably, I wanted to get your views on the European Parliament elections, which tend to pass without much notice usually, because they're seen as lesser than the national elections. But I wanted to get your view this year. The European elections are in the middle of the year, and the right, an extreme right even, could do quite well. That's the polling at the moment. Your thoughts on the importance of that election and how it could influence the direction of Europe, particularly vis-a-vis energy policy, vis-a-vis Ukraine and so forth?
It's certainly a very important election because the European Commission is approved by the European Parliament. So the composition of the European Parliament will certainly affect the composition of the European Commission, and the European Commission plays a crucial role in distributing money and in creating the conceptions such as the one of the European Green Deal. I would say there is a strong likelihood that the current coalition will persist, just with a stronger component of the right wing, of the right part of the coalition. Yeah.
When you say coalition, which coalition is that?
So basically, they have a coalition between central right, central left, and the liberal factions at the European Parliament. Analysts don't see a possibility of a major change. However, there is an internal change, particularly within the central right party, which on several dossiers will block with conservative in order to weaken certain dossiers, certain agendas. And I would say one may predict that the ambitious Green Deal can be corrected with the new elections. Regarding Ukraine,
Can
it's
be
harder
corrected,
to say.
sorry, changed?
Yeah, may be corrected. We cannot predict yet what can be there. But for example, you also on the news the farmers' protests, and the farmer protests shed a light on the climate policies, because a number of protest points are related directly to the climate policies. Yeah, so and that will certainly affect the electorate, and particularly the center-right electorate.
You wanted to just finish with a point on Ukraine.
Yeah, on Ukraine it's harder to predict because on Ukraine the consensus to support Ukraine is stronger than on Green Deal, let's say on the ambitious Green Deal, because I don't believe that European Union will close the energy transition at all. I mean, of course, energy transition will continue and must continue, but probably some of the dossiers, some of the priorities will be reshaped. And regarding Ukraine, is harder to predict because the conservative opposition to the existing mainstream is divided between those who would like to help Ukraine even more and those who would like to withdraw from helping Ukraine. And therefore, we rather see polarization between different political discourses, but I don't see the end of the consensus that Ukraine needs to be supported.
Right.
But
Okay.
again, anything can be different in a few months.
Yeah. Yes, it can. It's a fast-moving situation, and the US is still yet to agree on its funding for Ukraine. Brent crude oil trading this morning at $82.50. Little changed. Oil markets have priced in higher for longer rates. And we wrap it up there. Victor Yang in China, Dr. Nasseri in Dubai, and Dr. Belli, of course, in Europe. Thank you so much for your insights and contributions this morning. We look forward to seeing everybody again every morning at 10:30 UAE time. And the podcast is published on social media after its recording now. Thank you so much.